Welcome, everybody. Welcome, everybody, to today's session. Very excited that everybody's here. We're letting a couple more people join us as we start off this session together, seeing some familiar faces, seeing some new faces. Very excited about this. So, to cover non-dilutive financing and grants and everything in one session is it's a little tough, but I'm going to go over some strategies that will allow you to really understand why non-dilutive funding is important to a small business, especially a startup, and what are the grant cycles out there? What are some frameworks, some of the timelines that you should be aware of? I have like 3 slides that are SBIR or STTR specific. At that time, when I get there, we might not be able to cover it, but the slides will be available. So just letting you know that if we have time, I'll cover it. But this is meant to have you have a really great understanding of what that looks like for you and your business. Let me share my screen really quick. So I'm going to go back up to the top, get this all squared away. And I can't see what I'm doing here, so give me a second and present. There we go. See. I think everybody can see this. So can somebody give me a thumbs up that they can see it? Thank you, Matt. Wonderful. So yeah, so really when you're looking at your startup, you can, is this not in, let me just do this so that's better. I think that's better. Perfect there. It's not so distracting. Wonderful. Let's see. Can everybody see it? My screen share is paused. Let me try to share it again one more time. Can you see that? Matt, can you give me a thumbs up for that? Okay, thank you. Wonderful. Okay. So when you're thinking about raising money for your startup, a lot of people go straight to that investor. That investor is going to be the best thing in the whole wide world, all of that. But really, your equity and your ownership of your own company is being diluted each time you get an investor, if you're doing the traditional route of angel investing in VC. So typically, you're looking at some other type of grant money that is non-dilutive, right? You've probably heard that, NDF or non-dilutive funding, and that is tax credits, grants, alternative capital structures that fuel that growth of your company so that you have scalable growth. We're not going to cover, let's say, bootstrapping. It's between bootstrapping, friends and family, that you're not giving away equity, and that you're really seeking funding from other sources to have your company scale. So today, I really wanted to have you think about a couple of different things. You want to decide your next fundable milestone. So one of the things, if you're going to do angel or you're going to go this route of non-dilutive funding, what is your milestone that you're trying to get to be able to get that money to fund to fund everything leading up to that milestone? Then understand today's non-dilutive landscape. I tried to combine some of the strategies of debt. What you need to consider about debt is not the same, but similar types of structure as the non-dilutive funding, and then craft your unique value proposition, master or understand the SBIR, STTR strategy, and integrate the 6 C's framework. So if you've ever heard about angel investor, venture capital, it's like the 3 C's of capital is super important. That's financial, network, relational, and experiential capital. And then there's credit C's, that if you're going to a bank, these are the things that the bank is going to look at. That's character, capacity, capital, conditions, and collateral, right? Everybody's heard about collateral when you're trying to get debt, right? It's the same sort of thing as these grants. And we're all going to go through it because it's just easier for you to say, okay, do I have all the C's covered, right? So I try to make it a little bit easier for you to understand. So with that, The strategic question every founder must answer is that the default path that everybody thinks is equity first, but you're immediately getting diluted of your founder stake. There's board seats and voting rights are transferred. There's people that are in your business letting you know how to do it and what timeline to do it in. And sometimes there's misaligned timelines between founder vision and investor returns. So they want you to have a return faster. They're only going to get their return if you sell, right? If there's a merger and acquisition, there's an IPO or some kind of activity that allows them to gain their return on investment back. Now, the strategic alternative that we're talking about today is non-dilutive first. So thinking about capital sequencing of the non-dilutive funding, grants, money that's coming in that is not tied to equity. So zero ownership dilution during critical R&D phases, that's research and development phases, is really important. You don't want to waste all of your equity on research and development phase. And also, when you're looking at the sequence of going from non-dilutive to dilutive, those angel investors and VCs are going to say, have you actually considered any non-dilutive funding that actually pays for the R&D so that they are only paying for scalability? They're only paying for that next level piece because that R&D costs a lot of money. And also non-dilutive funding comes with built-in valuation through milestone achievement, also built-in validation of, let's say you're getting that grant from a technical foundation or a technical organization like the National Science Foundation. There's validation in that you might not get always with any kind of angel investor and VC. So think about those two pieces, those two paths. And we're going to talk about that non-dilutive path first. So non-dilutive funding versus equity is that non-dilutive is actually a valuation multiplier. So the cost of non-dilutive funding is time, effort, and compliance requirements. We're going to talk about as soon as you get that money, you do have compliance. That means reports and all of that to be able to either get the next tranche of grant money or the next tier of funding. Then the dilution is zero ownership impact. The strategic goal is to de-risk that research and development and achieve those technical milestones. And then also validate product market fit. You might not be able to get to product market fit that is 100% tried and true. You've tested it 1,000 times, no, but you will get that validation. So that valuation impact is that it increases future valuation, company valuation by proving concept and reducing that technical risk. Now, on the equity financing side, the cost is ownership percentage. You have board control that you're giving away, alignment on exit strategy, right? And there is a dilution. There's permanent reduction in founder stake when you're thinking about equity financing. And the strategic goal is to fund rapid scaling activities. I put here TRL 7. We are going to go into what that is. That is technology readiness levels of 7 and above. It's not like 1, 2, 3, 4, 5, 6. It's above that. And then market expansion and team building. The valuation impact is it reduces the founder ownership through dilution and though accelerates growth trajectory. So think about those two things. And the hybrid strategy is deployment of these public funds and non-dilutive sources to absorb some of that early stage risk so that when you talk to investors, you're de-risking them and that you have a proven concept to be able to have viability and reduced execution risk. One thing that is specific for end of year, and I'll do the end of year one next month, but when you're looking at non-dilutive funding and equity financing, we'll go through the strategy and the timelines, but this type of non-dilutive funding is a little bit longer to actually go after, execute, get the money is a longer time period. However, by end of year, you should be tying the knot on any equity financing opportunities that you have with angel investors and VCs. So no matter what, we're going to talk about some of the timing that is right now about non-dilutive funding. So if you at least have a strategy for end of year and into 2026, then you can actually talk about, I'm thinking about non-dilutive funding, and that actually de-risks you already. So just wanted to let you know that that might be a strategy that you want to take on. Okay, so next up is the 8 essentials grant types for startups. So I try to distill as much as information as possible. Is that the non-dilutive funding landscape is far more diverse than most founders realize. You think it's only X grants and Y angel investors. There's a whole plethora of things. So this SBIR STTR, America's Seed Fund, is the gold standard for R&D. And we actually cover that in at the SBDC. We have a whole writing workshop that allows you to get really great SBIR, STTR grants out the door. That does not mean that you might get them, but we give you that resource. Then there's R&D tax credits that are structured reimbursements for incurred R&D labor. Then we have state and local economic development. So that really is focused on any kind of facility expansion subsidies or job creation initiatives and geographic zone development programs that are tied to local economic impact. So let's say that you are creating jobs in an environment in a specific geography. You can maybe go after some of those grants. Corporate grants and sponsorships kind of are tied together a little bit with industry specific grants. I'll kind of talk about those two interchangeably, but the corporate grants and sponsorships are solutions aligned corporate social responsibility mandates. So something about the innovation pipeline or the HR or what they're doing as a company is tied into that. The industry specific grant is highly specialized programs for regulated sectors, including clean energy, biomedical devices, all of those pieces. Anything that touches corporate, especially these two, and a little bit about the innovation challenges if they are in corporate, that is such a great way to get your foot in to your exit plan. Right. Yes, that is about 4 or 5 years later, but can you do these little grants, industry specific grants? Maybe they're like, oh, we need to increase the number of engineers, or we're going to do something that's specific to solar. Then you can go after that, and maybe there's another grant later on that's about something else, and then you're getting creeping closer to go to that towards that exit. Philanthropic foundations, mission-driven capital for ventures with clear social or environmental impact goals. Actually, one of my portfolio companies went after one of these foundations, and they got $500,000 grant from them, and they were a for-profit entity. Like the for-profit entity startup got that grant from a philanthropic foundation. You have to be aligned with their values. So if you're looking at something, check to see that they do invest or give grants to for-profits, and that you are really aligned to their values. That's what I would just really, the top level piece, I would really look at that. Then innovation challenges and prizes. Minimal bureaucracy, pathways to quick proof of concept, or solving narrow, well-defined problems. So those are like pitches or the X Prize challenge. Go after all of them that you can. I know a couple of my portfolio companies, I always go back to that. One of them was doing like AI chemical like research for, let's say, new sprays, new paints, new everything like that. Well, there was a lot of challenges in like the chemical engineering environment to be like, okay, this is a prize on the newest innovation on this. And then there's like the best 30 over 30 founder or something like that. And she went after all of them, and she was able to actually raise enough money to get through a very critical time of R&D. So knowing what your goals are and what your milestone is, you can pitch to be able to get there. Another woman did exactly the same thing too. University incubator and translational funds. So look back at seed funding, especially designed for intellectual property spin-outs from universities or academic research institutions. And if you are part of a university, go back to your university and see, like, do they have an incubator? Can I join it? Can I not? Do they have like a fund? Rady at Rady School of Management has the Rady Venture Fund. They invest actually in companies that are Rady alum. Right. One of the little pieces of their thesis of their fund, and it's sort of like an university incubator or funds, they actually invest in that. So look at all of those things. So this is just like not an exhaustive list, but some place to start. Next up is the grantor's lens, the 3 C's of capital that I talked about earlier. First, obviously, is financial capital. It's that monetary resource that you really need. But it clearly traces the inputs that you have, the activities that you're doing to get to those milestones, and then the outputs that are coming out of it. They're going to ask for outcomes as well. So think about financial capital for non-dilutive capital is that they will probably want some kind of return on impact as well as return on investment. So investors are going to, double take into the return on investment. The grantors and the non-dilutive funding foundations are going to double click onto return on impact. But still, that logic model framework allows you to understand like that's where they're looking at. They're not looking for money in, you're going to be alive for 5 years, we're going to get our money out. It's more of this like more academic per se. Let's just leave it like that. What you must deliver is a detailed defensible budget. There's budget narratives and all of that. So understand that you're going to have a budget, but you're going to have a narrative that allows you to like spell out how you're going to use all that money. Then it's cost sharing documents, evidence of matching funds or in-kind contributions that demonstrates organizational commitment, and the sustainability plan is how the project continues beyond grant funding through revenue generation or follow-on funding. So sometimes some of those grants allow you to say, okay, you can get the first tranche here, the second tranche, you need to bring in investors so that it is double investment basically on both sides, public and private sides, and be able to leverage the money that they're putting into your company. So think about all of those things and think about that if you can really actually execute on that logic model of what you're doing in your company, and then let's say the model of sustainability and making sure that you're doubling that money or doubling the impact that you're doing. So next up is that network capital and also relational capital. So I'm going to go into that network capital is that for grants specifically, right? It's about the power of strategic relationships. So for equity crowdfunding, I mean, for equity funding and capital there, it's typically, financial capital, resource capital, and experiential capital. So what is that investor coming in as their experience? But in the grant arena, that resource capital is really in 2 different buckets. One is network, and then of course the other one is resource. Is that there needs to be strategic partners that you're going to go after. Network capital represents the ecosystem of relationships that allows you to be as successful as possible. Then usually they're asking for letters of support or letters of commitment. That is might be a little bit different than LOIs, which are letters of intent and memos of understanding further along that timeline for those investors. You're looking at letters of support that you have other organizations or other foundations that are helping you do the things that you need to do, right? Number 3 is market research and amplification. So it needs to be demonstrated that strong network capital demonstrates your ability to achieve impact beyond the direct project outcomes. Can your partners help you reach underserved populations? Do they provide distribution channels? All of those things are part of that market reach. Next up is that relational or resource capital and resource capital. So that relational capital is that you have people working together, you have shared missions, you have compliance history, clean track record of meeting reporting requirements. Do you have everything in place? Do you have a governance of like a board, an advisory board? They're going to ask you about that. That is that, let's say, relational capital. And that's why I put the resource capital within the same slide, because grantors are going to see, okay, do you have this compliance history? Do you have this governance of people that are putting their trust in you and that you are building a great company with them? But that is really intricately connected with their resources, right? What do they bring on? Have they been part of have they been a CEO of some life science company? Are they the talent acquisition for this other one, and your technology does all HR AI HR platform or something like that. So that's intricately connected to this capital piece. And then also the other things is transparency and follow through. Are you delivering on promised milestones? Are you doing honest communication? All of those pieces allows for that grantor to say, I'm gonna invest. All of that is super important. Okay, so up next is the 5 C's of grant readiness. I know these 5 C's. I taught this course on debt for Meta, and we really looked at using what lenders really use to assess loan risk. So if you're going after loans, you're kind of learning a 2-for-1 tonight, is that you're thinking about loans and also this non-dilutive funding, but you're really trying to let that grantor know that that you are de-risked, right? And that you are ready for this grant to come in, and you will be ready to shepherd that, let's say, financial responsibility that you're getting from their money to the right thing. So this is a way that they evaluate risk of mission failure and non-compliance. So the 5 C's are the 5 that I mentioned at the very beginning is character, capacity, capital, conditions, and collateral, right? So I gave you side by side here. I'm very I'm excited about when I put this together. I'm like, yes, I kind of got it. So the traditional loan lending focus is all of these here, right? So like the character piece is credit score, right? But really for the grantor or grant readiness assessment, it's about like institutional integrity, ethical conduct record of principal investigator or whoever is the CEO, transparency and past grant management. All of those things are part that they're going to be looking at to evaluate, are you ready for this grant? If we give you $1 million, $2 million, will you be responsible for their money? Then capacity here is for the lending source is more like cash flow sufficiency to serve the debt obligations, right? Do you have the capacity to do that? So their analysis, the debt to income ratio. But looking at the grant readiness assessment, you have project execution capabilities. So realistic scope of work, proven ability to deliver on technical milestones. And that's part of what your, let's say, narrative would be like, look, we were able to do from here to here this technical milestone because we had, let's say, a connection with a university. We were able to execute it within 6 months. That's like, okay, you got it done. And then realistic scope of work, which is forward facing, is that saying like, you're not going to say, I can build an entire AI twin of the intellectual property that we spun out from the university in 3 months. It could be in about 2 years with AI, right? But as of right now, that might not be realistic, and they're going to be seeing that. So that capacity is super important. Number 3 is capital. In the traditional lending focus, it's owner investment amount, down payments, and all of that. So the part of the grantor, because you're super early, is demonstrated commitment through cost sharing, matching funds, in-kind contributions, anything that allows you to say, okay, this is how much the founder put in, X amount, even if it's like $1,000, something there, right? There's a commitment to cost sharing. Let's say I see a lot of startups that come to me for investment that say, okay, I need everything to be paid for by an investor. That's really is very hard to swallow as an investor because you should be able to cost share something, right? Especially like, let's say, life science companies. Could you be part of an incubator, right, that allows for you to have free space, that allows to de-risk that R&D, your cost sharing with somebody else, and getting pro bono services through this incubator or co-working space or something like that. So that capital is not just money, but what have you been able to leverage in your network? San Diego is a fantastic place to do it. You've already been doing this by being part of SBDC. You're not saying, hey, you know what, I'm going to pay money for some coach and advisors to coach me. I'm going to reach into the SBDC. I'm going to go to the free law center to get all of that done. Very, very cost efficient. And being good stewards of capital, right? So fourth is conditions. For the loan is loan purpose, macroeconomic climate, industry trends, all of that. So on the side of the grantor focus and the readiness of that grant is that the mission alignment with program mandates fit within the grantor strategic priorities and funding cycles. How do you get that information, right? You usually get it from whatever they're posting and whatever they're putting it out there. They're saying, we want this, this, and this. That's what that program mandate is. And then it's going to fit within the grantor strategic priorities. The priorities are usually labeled right there on the RFP, which is typically what they're asking for companies to bring grants to them. Then next up is collateral, lastly, right? So in the lending focus, it's physical assets pledged as security, liquidation value in case of default, right? What is that collateral? But for, let's say, grant readiness assessment, it's intellectual property. That's the collateral that you have. And the potential, and societal return on public investment. So any kind of intellectual property, even if you have trademarks and logos and all of that, that's part of that IP protection. That is part of that collateral at the earliest stage. So hopefully this allowed you to kind of really understand the risk, the credit risk of grant readiness, translating from lending, bank lending to grant lending of sorts, right? So I'm going to go through each one of them pretty, I've already kind of gone through it a little bit, but the character is more like the trust foundation. And I want to go through this character red flags, right? If you're having late or missed reports on prior grants, they'll know it. They're a small community. Inconsistencies between proposal and actual work. What I've seen whenever I've gone through some proposals is that the budget and budget narrative kind of says different things than, let's say, what is listed in the grant. Slight differences you can see as an evaluator because you evaluate so many. Conflict of interest not disclosed, right? There's a conflict of interest of let's say, a scientist at a university and how they're spitting out this company. Spending funds outside approved budget or overpromising and under-delivering. Next up is that capacity, proving you can execute. So, you can do that by multiple different ways. You can say, our past performance is this, our infrastructure is solid, our team credentials are this and this. Is we have the capacity, the mind capacity, we have the time capacity to actually get this executed. Next up is capital, demonstrating commitment. There's direct cost sharing that we've already talked about, in-kind contributions, and then leveraging funding. So have you amplified any kind of ways to do any of these, right? You've connected with people, you've asked for cost sharing, all of the things that you're showing your skin in the game. What is the founder's commitment of capital, right? What about your advisors? Your advisors who you have, maybe they're super early, but they're your advisors, and all of them have committed $5,000, even though it's a small amount. They have put that in there. That is that demonstrating commitment. Next up is the conditions, mission alignment. I've alluded to this, but basically that study the grantor's history. What types of projects have they funded previously? Usually on grantors' sites, you see a whole list. I was actually going through it this morning with somebody. They're like, okay, we have this whole list of this foundation that we're going to go after and apply for their grants. And we're going to evaluate some of these companies that they've already invested in and actually reach out to them and say, how has the interaction with that foundation been? Has it been great for you? Has it not been great for you? Mirror their language. Use terminology and framing from their strategic plan and program description. So you can get the RFP, you can get their website, and usually they have some kind of public facing information. Go into that and get that verbiage. What I like to do in my grant writing is that whenever I have a statement that really aligns to what they're asking for, I actually bold it. I bold it or I underline it. So if you're skimming a document, you see the things that are like, leveraging relationships and community. Boom, if they're thinking about community, or like serving underserved, supporting underserved entrepreneurs. I bold that, underline it, right? So if they're skimming the document, they're seeing their own language of their program and what they do for their company right on there. So address their pain points, explicitly explain how your project solves problems the grantor has identified, and then demonstrate awareness. Reference the grantor's broader portfolio and how your project complements existing investments. So you should say something, it's not as explicit as this probably, but you have been very connected in, let's say, serving underserved communities in big cities. Well, we're doing the same thing. We're going after cities, really helping with economic development in cities, allowing for different resources to be allocated. So that's a conditions part. Collateral, we already talked about this, IP and societal impact, but like the societal return is something that might not be as forward facing for some people, is that you might be, creating jobs. There might be some health outcomes that are improved because of your technology. Environmental impact, educational opportunities expanded, economic development catalyzed in underserved areas, technology transfer to commercial markets. Clearly articulate the IP and the societal return as that collateral when you don't have, let's say, collateral of like an apartment or a car to put a collateral, that you would do that mostly for bank loans. Okay, so up next is just the framework all kind of spelled out that you have, and the 3 C's. So the 3 C's and the 5 C's of credit becomes more of like a 6C framework for non-dilutive funding worthiness. And I created it myself. So if it's wrong, I'm sorry, but it is based on a lot of research and many years of doing both, of being an investor, angel investor, and then also being a grant writer for many, many years. So character and relational capital is that trust piece over here. Then that network capital is leveraging strategic partners for amplified impact. And you can also think about network capital as what's the next step for you, right? If they fund you, right, $1 million, then what would be your next step to say, like, I actually have that network to be able to carry on that funding next. The collateral is IP and impact. Then capacity is demonstrating execution. Capital and financial capital is commitment through cost sharing, rigorous budgeting, and being good financial stewards of the money that you're bringing into your company and the revenue that you're bringing in. Is all that being taken care of very purposely? Yes, you're good to go. Then conditions and mission fit. Achieve authentic alignment with grantor priorities. That is more important for this type of non-dilutive capital than, let's say, angel investors and VCs. So the other part of this is that after you get the grant, there's a compliance imperative. So you have fiduciaries, stewardship is really important. You have to kind of show that you can do it. And then post, are you doing the right things? Are you using the right amount of funding that you need to get to the milestones that they want you to get to? Okay, so with that, let's go through, go next. Okay, this is SBIR and STTR. I'll go through it pretty quick, 5 or 10 minutes. But the Small Business Innovation Research and the Small Business Technology Transfer programs really give out a lot of funding for startups. I'm not going to go into the political environment right now of where that is right now, but know that it has been tried and true for many, many years. So if it is something that is important for your company, it's always nice to be able to know the timelines that these are in, develop your grant narrative and what you have to go forwards. And if it does shut down, at least you have that piece of information ready for other grants, right? And other opportunities, and also being in front of investors as well, angels and VCs. So with this is that the program structure and scale is about $4 billion annually. There's 11 federal agencies, DOD, NIH, NSF, NASA, DOE, that's, a Department of Defense, and Departments of Energy, and 6 others participate in all of this. So when you're looking and doing research, you have to see, do I align to any of these, right? The 5,000 plus awards annually, so thousands of small businesses get funded across all phases. So SBIR is typically the small business must perform at least 2/3 of phase 1 work, and then they must perform at least 1/2 of phase 2 work. So the STTR is that research partner must perform at least 30% of the work, and small business must perform 40% of the work. So it's a little bit of a distinction there of what both of them do. And so it's typically a 3-phase pipeline. Phase 1 is feasibility. You want to establish technical merit and feasibility. It's typically 6 to 12 months. And then you have about 50,000 to 400,000. That's usually proof of concept. And if you see POC, that is proof of concept, demonstrating technical viability, right? And approximately 15% of proposals are funded. Then phase 2 is more research and development execution, full-scale research and development based on phase 1 results. And that's about 24 months typically. And that's about 250K to 2 million. And that's because of a successful phase 1 and completion or direct to phase 2 eligibility. So that's approximately 40 to 50% of phase 1 winners receive phase 2 because they're doing great work. They've showed that competency, the context, the capitalization, the usage of funds, all of those things allows them to be successful in phase 2. And then phase 3 is commercialization, really transition technology to commercial market or government procurement, and then ongoing no time limit. So that's what those 3 phases look like. And if you see this like this, typically whenever you have any other grant cycle that has tiers like phase 1, 2, and 3, think about these types of things. One is typically, I've seen them over and over again, it's typically like feasibility or let's say testing out something. The next phase is more like execution of what you've promised in phase 1. And then it's like, okay, you've learned a lot, you have done a lot of research. Now it's like really getting to market and seeing how does that like hockey stick go. So typically if you have 1, 2, 3 tiers or 1 or 2 tiers, follows the same sort of thing as this one. That's why I wanted to go through this. So up next is just phase 1 strategy. You want to build your foundation for phase 1. You want to have that alignment. We've already talked about that. Technical credibility of the team is super important. And then the innovation thesis is where I wanted to stop, because it's like the clear articulation of what's novel about your approach versus existing solutions. Because the ones that are reviewing these phase 1 grants know their industry very, very, very well. They know when it's something very new and something that's not so new, one that is kind of going off of an existing solution, and then or not. And then the commercial potential is super important. So preliminary market analysis, and know that the SBDC can support you on that market analysis piece. Talk to your advisor and see how they can help you with that. Then phase 2 is that scaling your success, right? Leveraging phase 1 results and making sure that the reviewers are expecting to see clear progression. And are you communicating that? That's one thing that sometimes with technologists or somebody who's very tied to their product or they're research heavy, it's hard for them to communicate that. So it's always good to work with a business writer or somebody who's in your network that can review that. To have somebody else review it, because that communication needs to come through. Then strengthen that commercialization pipeline and then build your team. So phase 2 budget support hiring additional personnel that allows you to do the good work that you have already done in phase 1. And then phase 3, I'm going to go after the technology readiness levels. Is that these are, I hope people have heard of technology readiness levels, but that's the TRLs 1 through 7 or 9, right? So basic research is right here, TRLs 1 through 2, generally not fundable through SBIR. Then TRL 3 and 4 is phase 1 target. So prime territory for phase 1 funding. You get through that, you do proof of concept, and then you go to phase 2 target, which TRLs 5 through 6. core focus of phase two funding. So you have your prototype demonstration, you know that it's validated, that it's operational, and going into the environment that you want. And then it's like TRL 7 through 9 is commercialization. So, and your question is, where do angel investors and VCs go in on that? They can kind of go in all different sections here, depending on the technology. So it's a very highly technical, needs $5 million of like R&D, then really R&D and is being funded by STTR, SBIR grants in these kind of phases, right? You need to get to that commercialization before, let's say, an angel investor and VC comes in. If it's not so technical, right, that you can create a MVP or a prototype, and that you can work with angel investors and VCs to kind of get it to commercial, and you don't need that much more grant funding to get you there, that could be it. So my answer to where do they fit in, it all depends, right? Okay. I'm going to run out of time. So the winning SBR STTR is to really think about shifting your mindset. And this is shifting a mindset for any grants, is you are a vendor, not an applicant. The government is your customer, right? They've published an RFP, the topic description, and your proposal is your response to their specific requirements. That is why you need to articulate why your solution is the best, why you're going to be, you are the team that can execute this. And that's exactly what that alignment is. Okay. So, let's go down this way. Okay. I wanted to, let's just take, let's say 2 minutes and say, okay, so as we like shift our mindset, is that this is the $150,000 thought experiment. If you landed 150K, if 150K landed in your account tomorrow, what would you do? With no strings attached, what specific milestones would you be enabled to achieve? And when you have that, just write it in the chat so I can get some people's so if 150K landed in your account tomorrow, what would you do? And when I did this same presentation to UCSD faculty, alumni, researchers, they're like, 150 wouldn't do anything for me. So some of them like, I need a 500K. So whatever it is to get to a milestone, think about that and write it in the chat what you would do. So we have one, yeah, so Mohan says develop a prototype. That's awesome. Another person says optimize the final engineering element of our product. Yes. Build out another person says build out our team, hire pair planners to support the client work. Another person says integrate giveaways into multiple strategic major cities and events. Complete my MVP. Wonderful. I love these, and keep on going because I love this. So these are great examples. Complete my MVP. Integrate certain pieces of it. To make sure that I know what cities to go into, build out my team to support client work, right? To, let's say, customer service or something like that. Optimize the final engineering element, right? So optimization, building, developing is super important. So examples of milestone thinking is complete beta testing with 50 pilot customers and achieve product market fit validation. Hire a VP of engineering and build the core platform to functional prototype stage. So this is important because it's kind of goes towards that like SMART goal, right? Is specific, measurable, attainable, realistic, and time bound. That's SMART goals. Is what do you actually need to accomplish if you got the 150K? So I wanted to, and I built out this so that we can think about it. What are the milestones that are measurable and objective? How are you going to de-risk your business in a meaningful way, right? So is like completing the MVP de-risking? I believe so, right? is integrating giveaways, de-risking the business in a meaningful way, is building out my team, is meaningful, yes. And can you articulate why this milestone matters to customers, investors, or society, right? So for that grant, is really important for them to know what is that impact. Remember that that piece of the value chain of saying, okay, we're going to have some inputs coming in, we're going to do some things, we're going to have some outputs, and then the impact. Think about that whole continuum and say, okay, why are these milestones mattering to customers and investors, and the impact that it's going to have on society? So funders care about all of those pieces, the outcomes, which are the milestones, not the inputs necessarily of activities. So you guys are all on the right track. So well done there. And so wanted to kind of talk about that. The landscape is shifting. There's a shifting winds, as everybody knows. So the funding landscape is changing fast with fewer guarantees and more scrutiny. So we've talked about that in other investor readiness things, is that angel investors and VCs are taking longer to do due diligence, right? So expect to take it longer to get that money in. Same thing with grants, is that it's more scrutiny, right? It's more people who are applying for it, and the more scrutiny and rigor into that. So how you can mitigate that is that you give more information, right? That you not give more information so that like somebody else can take your intellectual property. No, but what is it that allows you to be as successful as possible? And what are the specifics that you can get to that milestone? I would say like about 2 years ago, you could say my milestone, I'm going to get here and maybe overinflate something. Now it's like, I'm going to get to this milestone because I'm going to do X, Y, Z, and that's tied to a specific output. It's because I know that I'm going to get 1,000 users, right? It's not 10,000 users or any user. It's really specific. So that's why. And then I kind of laid this all out saying that the current status, and then some key changes, and then some implications. So capital sources are corporate grants and partnerships. They're highly constrained right now. The DEI programs are rolling back significantly, so corporate innovation budgets are cut, but the focus is still on mission-aligned corporate partners, not transactional grants. I've seen that same thing for even a not-for-profit. My not-for-profit is that we really need to be more aligned, more working together so that it's not transactional. So how do you get there is warm introductions and making sure that you connect with them. CDFI lending is reduced capacity right now. So there's major federal budget cuts. Some lenders paused applications, and longer processing times and stricter underwriting. So apply early in a fiscal year when capital is freshest. That would be my biggest tip. And strengthen credit profile before approaching to CDFIs. So don't go into it saying, okay, my credit is fine. It's like, okay, what can we do to mitigate? Maybe meet with an advisor at SBDCs, be like, how do I do that? We have financial advisors, and say, okay, how do I help my credit profile before I apply? Not let's apply and then figure it out, right? Just so that just shift that focus a little bit. Federal grants like SBIR, STTR, they're stable but competitive. There was a brief funding freeze resolved, and it has been resolved. So programs continue, but competition intensifies as more startups seek non-dilutive capital. And then the gold standard remains viable for tech companies. SBA loans is mixed access. Programs available, but terms less favorable. Lenders are more risk averse. They're scared about like giving away their equity, or they're giving away their money, their capital. And so personal guarantee requirements are stricter. And then best for established businesses with revenue and assets. And then foundation grants is discretionary risk. Often first budget cuts in downturns, right? So focus shifted to direct service organizations over entrepreneurial ventures. So how, and knowing that and talking to the people that have already received those grants, even in the last year, might be really great to mitigate that. Say, how are they doing it? What has happened? What can we mitigate before we even apply? Okay, so up next is, I want to do the timing piece right now. Yeah, so let me just make sure I'm here. Yeah. So the grant calendar is when to apply. And I wanted to kind of go through this because that goes into the other theme we wanted to talk about today was like, how do you get to end of year? Is it September and October is peak season. Grant season launches and nonprofit and government deadlines align with federal fiscal year start October 1st. So we talked about, trying to get in early. Even right now, November 4th or 5th, you are at the very beginning of that federal fiscal year. Competition is intense, but capital is abundant. You don't want to get to the end of the year and then they're like, oh, we only have $10,000 more dollars, and they're going to be even more scrutinous on the funding that they give away. November to December is year-end push. You have final Q4 grant submissions and end of year corporate giving deadlines. So organizations rush to allocate remaining budgets. So, but for a really good opportunity for fast turnaround applications. Then thinking about the first quarter of the next year, 2026, is January to February is lagged activity. Some state and local grants open, but overall slower period. Use this time to build relationships, right? Not in the craziness, but build relationships. Maybe they have some events or some get to know them. Go to all of those as much as possible. They are still doing quite a bit virtually. So look at some things that are virtual because some of these foundations are nationwide. Then March through April is spring cycle. Grant season stirs again with federal cycles opening and fiscal year alignment deadlines and early preparation from winter months payoff. Then May and June is high activity again. A lot of grants peak with many fiscal year ends June 30th. And then July and August is that summer lull, right? Lightest grant season with fewer deadlines and reduced volume. So some programs pause, but ideal for preparation rather than submission. So prepare things, get your credit ready, get all your team bios together. If you need to add an advisor because you've done a risk analysis of like where your gaps are, bring that advisor in so that you have that core capability in your team and your advisory council to increase capability and credibility. You see how you can go back to those C's at the very beginning and say, how do I do that? How do I build those things up so that I'm a better person to get those grants? So we have about 4 more minutes left. I'm going to not go through the selling proposition because that's typically covered by marketing, our wonderful marketing workshops that are out there in the world. So I wanted to just cover at the very end is that non-equity financing options are out there. We have covered that grants and non-dilutive funding right here, right? And also we've a little bit touched on the debt and bank financing, but there is like customer financing is that if you're doing a B2B solution as a startup, you can, and I've seen more and more of this lately, is that it's not a free pilot, it is a paid pilot. There's pre-sales going on. So really trying to get that customer financing up front more than maybe 2 years from now. Crowdfunding is always a crowd pleaser, right? Kickstarter, Indiegogo, if that's something that would be relevant to you. And also equity crowdfunding, and then factoring and invoice financing. So factoring is when a individual or a bank sees all your P&L, how you're doing, and then they factor or they put money together to pay for that manufacturing for you. Or that you have an invoice and you take it to a bank and say, I have this invoice, I just have to get the manufacturing done, and they take that ownership on. And maybe sometimes they take on, let's say, $1 or $2 for each product that you sell, and that's reduced margins on your side, but it's still a good thing. And then self-financing and bootstrapping is obviously another piece to the non-equity financing solutions. So we're not going to go into this is here. So I'll just kind of pause here a little bit because this is some of the crowdfunding platforms, but you want to find your fit. And that's a little bit of the theme that we've talked about this whole time, is that finding your fit for the non-dilutive capital, the grants that you're going to go after, the banks that you go after that are going to give you a loan, the investors, angel investors and VCs, and crowdfunding platforms. Find your fit. Kickstarter is more physical products. Indiegogo is a broader range. GoFundMe is more personal causes. Fundly is businesses and causes, and Open IDEO is more like social innovation. So I'm not going to go into credit and loans. Perfect. Yeah. So immediate next steps in the last 2 minutes is that three things that I want you to just like walk away with is number one is start tracking your R&D expenses now. Even if you're, not yet claiming R&D tax credits, or that you are, doing R&D, you're building an app, you're building a technology, track what your personnel time is, materials and supplies, contract research expenses, and even cloud computing resources. Track everything so you know what that R&D expenses is. Secondly is develop a professional work breakdown structure. So create a detailed milestone-based project plan that you can say, okay, I need to get to this milestone. What do I need to do? Boom, boom, boom. These establish objectives that have like success criteria or KPIs to allow you to get there. But that also you're identifying risk and also mitigation strategies. And lastly is identify 3 aligned grant programs, right? Is that there's so much out there. One of the chat questions is like, what's a list? You can get lists everywhere, right? You can get them, but it's how you use the list is what's going to really sell you to those grants and that grant organizations. It's similar to like a customer sales funnel. You could get customer lists from somebody else, but how you execute it, how you shepherd those relationships is what's going to make you successful in selling to those customers equally as selling to those grants. Okay, so understand what, study the past awards, contact program officers, mark application deadlines. All of those things are super important when you're trying to figure out, is this an alignment or not? And how do I write it so that when they see it, they're like, oh, they've done their research, and we will be funding them because they've done so much great work. So those are the three last things. And as I leave you, it's just more of thinking about all of these things as building capital fitness that is excellence in and execution, that you're replying to emails, that you're seeking great advice from people, you're executing really well. Then patient capital sequencing is that we're reaching to the end of the year. That's more of like who angel investors, VCs, maybe a quick personal loan through GoFundMe, and then have that long stretch, that long-term goal of getting more of the grants. Then measurable impact. What are you impacting society with, or the globe with, or people with? And seeing how does that go with your outputs that you have. Then fiduciary stewardship. Are you thinking about, oh, I can get AWS credit for this? Okay, let me go after that and get that so that I don't have to have somebody else pay for that. Relationship building is, we've talked about that ad nauseum, right? Advisors, mentors, co-founders, team, even the grantors and investors. Relationship build over transaction, please. That is what's going to get you the farthest. Because nowadays everybody's like, well, it's risk here and risk there and risk that, but you can mitigate that risk by building that relationship and building trust. And then lastly is strategic alignment, saying, okay, you want to reach these goals, grant organization. Well, we actually can help you reach those goals by these things. So that grant readiness all comes together and you really align to what they want. And that because you have the right mindset to get that grant for your product and your company to launch and scale. So with that, that is the end of this presentation. Hopefully this was great. Sorry that it was a switch of topics, but everybody wanted to hear it. So excited about that, and good luck on everything. Again, SBDC, the Brink is where this is coming from. It was investor readiness, thinking about non-dilutive capital and grants. Thanks for joining us today. We have advisors that can help you in every single part of this journey. So contact Stephen, contact the director at the Brink SBDC, contact the larger SBDC network, and we're here to serve you. So good luck, and can't wait to see how you launch and scale your businesses.